All right, we're here with Sean McGovern of Lloyd's today. We're speaking to him on the phone. He's in his office in London. Sean, how are you today?
I'm very good, Frank.
Good. I appreciate you taking the time to do this for us. Let me ask a question. I'm going to try to focus a little bit on Solvency II. In the United States, the prospective demise of the euro and the economic system that the Europeans have been working on for some time is often harped upon in all of these cable TV financial shows, supposing, I guess, with the problems in Greece and Spain and Portugal and Ireland, and then all of the discussions going on about their inability to issue a euro-wide bond, et cetera, et cetera. And now some of the deeper commentators have weighed in saying that the system is inherently flawed itself. And I mean, sort of as that as the backdrop, I mean, how do these drumbeats affect what's coming down the pike with Solvency II, which is obviously a gigantic initiative that everybody's been paying a lot of attention to and spending a lot of money on?
I think what you need to do is make a distinction between the difficulties that the European Monetary Union is facing versus the challenges of bringing around regulatory harmonization through a single market in the EU. At the moment, you have a system of European integration that is driven by uniformed rulemaking and harmonization of rulemaking, and then you separately have a monetary union. Obviously, the UK is part of the former, but not part of the monetary union. So the issues that you've raised around the instability of the European monetary union and question marks over whether you can have monetary union without fiscal union is really, I think, quite separate from what has largely been a success story for the EU, which is the creation of a single European market for services and for products. So I don't necessarily see the concerns around the euro infecting the entire European project.
So if, for example, and again, this is sheer conjecture, I grant you, for example, if the Germans suddenly get tired of increasing their retirement age to 67, so people in Greece can retire at the age of 61, and the bottom sort of falls out of the monetary union, you would expect the regulatory harmonization initiative to continue unimpeded.
I do think that there is a lot of advantage to the harmonisation through the single market that most people and businesses have benefited from as that has developed over time. We can spend a lot of time speculating over what will happen if there is a continued instability in the euro and if there is withdrawal of certain countries from the euro, but I don't necessarily see that is going to impact the single market and the continued efforts towards driving a single market for products and services.
Let's talk a little bit about Solvency II and lead into the regulatory model that they've been proposing and the solvency model that Lloyds has concluded with. About a year or so ago, we began to see comments from Swiss Re, Munich Re, Hannover Re, and then SCOR, and just about everybody else got on the boat, saying that insurers should not necessarily be treated by Solvency II as banks or financial companies, and the capital and reserve requirements that were being proposed were far too high. How has that developed? Have you reached an accommodation with them?
I think we're still in the process of trying to reach that accommodation. I think what the unfortunate thing for Solvency II is Solvency II has been in development now for between 10 and 15 years.
Yes.
And it's generally been something that the industry has been very supportive of, because ultimately to move to a regulatory system which is more risk-based and more sensitive to risk is hard to argue with. The challenge that the industry's had since 2007, 2008 and the financial crisis is that to some extent Solvency II has been infected by concerns around the financial services sector, banking sector, and we saw the development of the Solvency II rulemaking becoming very conservative as a consequence. And so what we've been doing as an industry for the last last couple of years is emphasising to policyholders, to policymakers, emphasising to governments that the insurance industry is different from banking. It's a different business model. It's had a very different experience through the financial crisis. Lloyds, for example, has posted record profits throughout the financial crisis. Our balance sheet has grown. Throughout the crisis, we made an investment return throughout. So that's a very different experience than our banking colleagues had. And we've got to avoid this reaction that we've seen from regulators, from policymakers, to somehow treat financial services as a single set of entities, rather than looking at the business model, looking at the risk, and targeting regulatory action to where the risks arise.
Let me ask you a question then. To that effect, when Dr. Ward and yourself and others, and carried on by Tom Bolt, embarked upon developing, I guess for lack of a better word, the Lloyd's solvency model, you took that, I don't want to say risk, but you took that step with an awareness of what the Solvency II requirements would be, or possibly would end up as, and develop something that you hoped would encompass that, and would hopefully have it pass muster. How did that evolve that way, that thinking, if you could share that?
Well, we've spent a lot of time thinking about our planning for Solvency II. We've invested significant sums of money as a marketplace in preparing ourselves for Solvency II, and our interest now is to get Solvency II implemented on time and in a way that was originally planned. There is a lot of talk about the potential for, or indeed the likelihood of a delay to the implementation of Solvency II from 1st January 2013 being pushed out a year to 1st January 2014, which is very unfortunate from our perspective, because I think an additional year is just going to add cost. And frankly, we want to get Solvency II implemented and get it embedded and running as part of our business. That is challenging because there is still a lack of clarity over the rules that ultimately Solvency II will impose, and clearly what we have to do is make sure that our implementation program, which is significant both in terms of the number of people and the amount of money that we're spending, is not getting too far ahead of where the ultimate rules will come out. I think we've got the balance right at the moment, but we're spending a lot of time monitoring what's going on in Europe, making sure that we're alive to and able to deal with changes as they happen.
I noticed our friend Luke Savage made some fairly strident comments about what would happen if this implementation was delayed. And I guess I can see that coming from representing an organization that has spent an awful lot of money getting compliant with this. I take your mutual points. There are going to be a number of effects with Solvency II coming through that quite possibly are going to impact underwriting operations, I would suspect, just insofar as claim reserving and bordereau standards, things of that nature, in order to attempt to get a little bit more granular and detailed. Can you talk a little bit about that?
Well, clearly, Solvency II, because it's a risk-based program, is going to look at risk across businesses, and that is going to be whether it's the way in which you price your business, whether it's the way in which you deal with operational risk within the business, whether it's the way in which you reserve for your business. So all those factors have to be taken into account as part of developing your internal capital model that is truly reflective of the risks to your business. Now, of course, this is a relatively new regime for Europe as a whole, but is not that new to the UK, which has had a risk-based capital regime in place since 2005 called the ICA process, the FSA brought in 2005. So the UK industry is in a pretty good position to take what they currently do through the ICAS risk-based capital framework into the new world of Solvency II internal models. But it is true that Solvency II will affect and touch on all parts of your business, because in order to be truly risk-based, it has to. So there's a very significant process of embedding it within the business. We have to be able to demonstrate to our regulator that we are using the capital models to manage the business, and we have to be able to demonstrate that a decision in one part of the business is not having an adverse effect in terms of capital on another part of the business. So it's a very extensive program, but fundamentally we support what Solvency II is trying to achieve. It's unfortunate that the process of developing the rules got derailed by the financial crisis, and it's unfortunate that we're seeing a delay in its implementation. But we remain committed that this is the right direction for insurance regulation to take.
Sean, in a funny way, many of the thrusts of Solvency II could be perceived as serving as excellent stalking horses to get quite a number of things done in a good hygiene way that should have been done perhaps a long time ago everywhere in this industry in order to better harmonize the various risk units operating under each risk-bearing umbrella, and making sure that the left hand knows what the right hand is doing, and making sure that risk-based capital being wagered or placed in one area is in fact being appropriately considered when another policy or quote is being made in another area of the same company.
I think that's right. I mean, basically what it does is it puts capital and risk at the heart of the way in which an insurance business is run, and makes it a board level responsibility. So yes, it clearly raises the expectations of the managers of insurance businesses, but I think that's a good thing.
I agree. Well, listen, we're at the end of our time. I wanted to thank you for spending some time with us, and we wish you well, and hope that you are able to gain a tremendous competitive advantage over others with the Solvency II, and I think you will, given the amount of time that you've spent on it. So thank you.
Thank you, Frank, and I look forward to speaking to you again.
Good.